Good morning, everyone, and thank you for joining us today. I'm Tom Quadman, Executive Vice President with the U.S. Chamber's Center for Capital Markets Competitiveness. And today I have the opportunity to be joined by FDIC Chairman McWilliams. Chairman McWilliams is going to talk about the efforts of the FDIC to strengthen the equality of opportunity for all Americans, an issue that we all care about and have been deeply involved in. For those of you who are not familiar with the chairman, she has an impressive background, and we're going to get into that a little bit with our discussion. Jelena McWilliams was sworn in as the 21st chairman of the FDIC on June 5th, 2018, an independent agency that has been protecting deposits since 1933. She serves a 60-year term on the FDIC Board of Directors and is designated as chairman for a term of 5 years. Chairman McWilliams has a unique blend of private and public sector experience, making her particularly effective in her current role. She has served as Executive Vice President, Chief Legal Officer, and Corporate Secretary for Fifth Third Bank in Cincinnati. She also worked in the U.S. Senate for 6 years on the Senate Banking Committee staff, as well as the staff of the Senate Small Business and Entrepreneurship Committee. She was also an attorney at the Federal Reserve Board of Governors and has practiced both corporate and securities law at law firms in California and D.C. Last year, the Wall Street Journal referred to the chairman as one of America's most inspiring bureaucrats. I'd actually cross out bureaucrats and put in people. And today we'll have a glimpse into why that is the case. So let us bring Chairman McWilliams in, and thank you for joining us today. How are you?
I'm all right. Thank you so much, Tom. And that's a wonderful introduction. I feel like I should just turn my camera off now because it can't go up from here, but thank you.
Oh, no. We're gonna keep on rising. So, Chairman McWilliams, the Chamber a few months ago launched an Equality of Opportunity initiative to develop and advance data-driven business and policy solutions to bridge opportunity gaps and ensure that minorities, particularly Black Americans, have greater opportunities to succeed. This includes access to capital for minority-owned businesses. The CCMC is leading this effort and is on a track where we know that there's a role for both the public and private sector to play when we talk about these issues. Before we start to get into the policy questions, I'd like to start with a more personal one because I think it is helpful for those joining us today to have a better understanding of what your motivation is around these issues, particularly of how credit and capital can play such an important role. Can you tell us a little bit about your journey to the FDIC? And I know free enterprise system is important for, in your view of how to bridge as a bridge to solve problems. So tell us a little bit about your personal experiences and how they've shaped your approach to financial inclusion.
No, absolutely. And I would just say it doesn't get more personal than my dog walking into the screen, but I claim he's the new, he has a sister here too. He's the new mascot for the FDIC, so I have just allowed him to freely roam while I have conference calls. So I would say, obviously, I have an accent if you hear me speak. So I came to the United States from former Yugoslavia with $500 in my pocket in 1991. And I use that story not to highlight the fact that, I came from elsewhere, but I use that story to basically highlight for people that it is still possible to come to America with nothing and to rise to, I would say, the higher echelons of the U.S. government and certain executive positions in the private sector within a couple of decades. And I refuse to believe that other people can do it. And if there are structural nuances in the system that are preventing people from succeeding in the way that I have been able to, then we need to remove them. And if it's a matter of opportunities and capital, it's important to me that we look at all of that. But I'll be frank with you, the system that I left behind was a unique form of communism and then socialism. So I grew up in both, I was born in communism, I was raised under socialism, and I decided that I would like to try living in capitalism in a democracy. And so with $500, I basically told my parents I want to go to the United States and succeed in a system that I believed in from afar. And I remember at that point in time, my father said to me, we were a lower middle class, I would say, if anything, probably a upper poor class, if there is such a level. And he said to me, why do you want to go to a system where you're always going to be a second-class citizen? And I said, I believe I can go to the United States and not be a second-class citizen, and I would much rather be a second-class citizen there than in my own country. So when I came to the United States, I realized that the there's disparity of opportunities depending on where you're born, who you're born to. Does your family have connections? Are your parents educated? And if they're not, are they pushing education on you? And then if they're pushing education on you, do you have the opportunity in your community to excel educationally into the school system? And do you know how to do that? And this is a large country. It's a geographically big country. It's a very diverse country, socio and economically. And those opportunities are not available to everybody. So it has been important to me when I came to the role of the FDIC chairman to work on making the banking system and the financial system that work for all, and to basically highlight the issues of belonging and inclusion in a way that I would like to see, not just in the financial system and banking, but all throughout the United States.
That's a fascinating story. I think that's one more people should know about, because as you said, if you pull yourself up by your bootstraps, you can go a long way in this country of ours. With that, in August, you gave a speech that signaled a greater role for the FDIC to play in promoting quality of opportunity. And you stated during that speech, as the nation's deposit insurer and primary supervisor of community banks, including minority depository institution MDIs, the FDIC plays an important role in helping these institutions meet the needs of their customers and communities, especially minority and low or moderate income communities. Now, you've indicated that the efforts by the FDIC to develop a framework that would match MDIs and CDFIs with investors interested in the particular challenges and opportunities facing those institutions and communities. Can you tell us some more about that initiative and what you're hoping to achieve with that?
Sure. So when I came to the FDIC, I looked at the organizational setup of the system, of our banking system. And, you have national banks, you have state charter banks that are regulated by the FDIC and the Federal Reserve System. And so within those, you have these institutions that we refer to as minority depository institutions, or MDIs. And I looked at the number of the MDIs in the United States, and as the consolidation in the banking industry has been happening over a number of years, it has been particularly hard on the MDIs. And then you start breaking down the MDIs based on the kind of economic or geographic diversity, and you realize that there are African American MDIs, the Hispanic MDIs, Asian MDIs, and Native American MDIs, and that's generally how we have grouped them. And then you realize that there are even disparities within those nuanced categories. And what we realized pretty quickly is that the representation of the African American banks, minority depository institutions within that ecosystem, even not just the bigger ecosystem that is our banking system, but the ecosystem of the MDIs, the numbers were dwindling down, and we were looking at a very, very serious consolidation in that area. So I started researching a little bit. Why is that? Are we talking about generational lack of opportunity in the system, or as you know, our laws and regulations have not been, to be very polite about it, have not been really friendly towards a large segment of the population over the centuries and over the decades. And so we started looking at why are African American MDIs behind other MDIs in their success rate and ability to grow and expand. And again, not all of African American MDIs are, you can do a deeper dive. And we realized that quite often they deal with small dollar deposits in a community that has been economically, frankly, devastated by the last recession. It didn't have a lot of wealth, household wealth to start with, and then was devastated by the last recession and has not recovered as quickly as some of the other communities throughout the United States. So when you have your depositors depositing $20 or $30 in the checking account, it costs you more on a per dollar basis to maintain those accounts than it does if you were a larger bank with a broader array of depositors and larger deposit amounts. So then we started thinking, what can the FDIC do? Like, you try to find a solution. And one of the things we said, well, maybe the voices of the MDIs are not heard enough here at the FDIC and in the broader banking system. So we have increased representation of MDIs. We actually tripled it on our Community Bank Advisory Council that advises the FDIC on outstanding issues in the community banking space. We also looked at, I like to call it the speed dating opportunities. We created speed dating opportunities where we held networking events to put MDIs and non-MDIs in the room together and educate both non-MDIs and MDIs on how collaboration between those two types of organizations can help both, right? And we have had some positive outcomes from those meetings where non-MDIs have both put deposits in the MDIs but also invested capital in support of those communities. And the way I look at it is you want your neighbor's lawn to be green, right? Because if their lawn is not green, your property value goes down as well. And if there's garbage in their yard and there's a broken car in front of their house, the entire street suffers. So in a way, that's a metaphor for how we have to look at the banking system in the United States, and why I believe that non-MDIs have a vested interest in their MDI brethren doing well and those communities being prosperous. And so then we thought, what else can be done, right? Is there anything else we can do at the FDIC? And I'll be honest with you, I kind of came up with an idea that was already out there. I watched on a plane, I watched an episode of Shark Tank. I generally don't have time to watch TV. And I kind of scratched my head and I said, well, why can't we create something that's like a Shark Tank for MDIs? And you can imagine the faces of our lawyers at the FDIC when I said, I want Shark Tank for MDIs, go figure it out. And they said, well, so long as you don't call it Shark Tank and we don't have any copyright infringement, we will go and figure something out. So we came up with this idea of a fund several months ago, and this is before the tragic events of the last 6 months unfolded. An idea of a fund that would be within the perimeters of what the FDIC can do statutorily, that would be funded from the outside parties, non-MDIs and corporations alike, and that we would be able to leverage every dollar invested in that fund by putting capital into the MDIs and CDFIs, and then that would get further leveraged. And we're right now in the process of setting up the fund and looking for potential investors to run the fund. And the idea here is to bring back some of even the profits back to the fund. So we're looking for benevolent investors. And I would be remiss if I didn't make a pitch. I know you have a number of entities within the umbrella of the Chamber, which is a very esteemed organization. And I would hope that you will take a look at this fund and consider if there are opportunities for your corporation to contribute and see if the success of the minority depository institutions and the communities that they serve can be exacerbated by that commitment. So I'm going to put in a little plug, if you don't mind. Can I give the
Please do, yeah.
This is free advertising, I'm excited. So the website is www.fdic.gov/mission-driven fund, and that's the name of the fund, mission-driven fund. Or you can send emails to mission-drivenfund@fdic.gov. And we have been able to secure a commitment from Microsoft, which I am extremely grateful for, in the amount of $100 million to start the fund. So we have, I would say, we have a seed investor in our Shark Tank.
That is some great news. And as we were talking about just before we came on, Julie Stitzel at the CCMC is leading a whole robust effort on minority access to capital, and we're going to do a few roundtables, and we're putting together an advocacy program and all that. But one of the interesting things as well is that we've been talking with different companies, and what they're also starting to do is to put their financial resources around some of these efforts. So by that, I know Tom Wilson at Allstate, the CEO of Allstate, is doing some interesting things where he's actually working with minority firms in terms of how they're doing some debt offerings. So not only will we make sure to publicize the fund, but what I'd like to do as well, maybe we can sit down with some of your staff and we can see how we could work together to marry up what you're doing as well as what some in the private industry are doing as well.
Absolutely, that would be wonderful. And again, if anybody is interested in how the fund would actually help low and moderate income communities, and primarily communities of color, we're more than happy to provide that. We'll have some pamphlets that are available later, and we can certainly distribute them to you for further distribution as well.
Sure. Yeah, any which way we can help, we will be. Along those lines too, you're one of three federal banking regulatory agencies, probably a couple more if you want to add in the CFPB, et cetera. But how are you also working with your brethren agencies to help amplify the efforts that you've been leading on here?
Sure, Tom. But really, the way you should have started that sentence is that you're the best of the 5 regulatory agencies.
You are.
Pretty much, after 4 all the time. No, they're doing a great job. So we have worked across the lines with other regulatory agencies to make sure that this is something that can be supported on a broader level. And we certainly welcome involvement by especially OCC and the Fed, but also CFPB and COA, et cetera. As you know, we don't regulate credit unions, so this is for institutions that are that get deposit insurance through the FDIC. So they have to be FDIC insured to partake in this fund. But we're more than open, and that includes the CDFIs, but we're more than open to kind of thinking even bigger. And obviously it took some serious thinking outside of the box to come up with the idea of a fund as a federal government agency. And at one point, frankly, we didn't know if we had the authority, and just thinking of, how can we do this? Can we do this? But I think we have been able to work through the legal issues as to how exactly to create good corporate governance for the fund and not have the fund be managed directly by the FDIC. So we are looking at a number of different things, and we're happy to work with whoever is willing to work with us to help MDIs and CDFIs help the communities that have been traditionally underserved or have been traditionally economically disadvantaged.
How are you also looking to develop metrics to determine success, and also how is it that you're also looking for this program to have long-lasting impact? And we're thinking about those same things too, right? Because we want to make sure that we can measure success with our efforts, and we want to make sure as well that the chamber, as well as our members in working on these issues, that we're just not, putting some money in and then just sort of walking away. We want to actually make sure that this is a long sustained effort. I know that's what you're thinking is too. So how are you trying to achieve one long lasting success, and then how could you measure it?
Sure. And it's a great question, and the question that frankly may be a little bit easier for us to accomplish because of the metrics we get from banks. So you could look at the number of MDIs, and in particular African-American MDIs out there, and see if over time, because of the infusion of capital, they're growing in size, if they're serving a broader range of customers, if their customers are able to obtain home loans, et cetera, et cetera. So we can actually see those metrics we can collect through our call report and bank supervisory channels on an ongoing basis. We can also, frankly, look at the footprint of the communities that they serve by the census track. And I think this is where some of the reforms that the OCC and the FDIC have engaged in on the Community Reinvestment Act, and OCC has finalized theirs, we have not finalized ours, but there's probably more we can do there to collect the right type of data to understand how those communities are doing. And the last thing we want to do is that we put in $1 into this fund and $1 comes out. What we're trying to do is that you put in $1 in, that dollar gets funneled to the MDIs and CDFIs by being $1 funneled to them in equity and then and capital, and then they're able to leverage that $1 for $6, $7, $8, $9, $10, depending on the opportunities they have in their communities. So I think that this is the model that could have multipliers along the way. And frankly, the greatest opportunity that I hope we can achieve, and probably not during my tenure, I have about 2.5 years left, but would be that we actually don't need this fund because there's no need in those communities, but I think we're far away from being there. So I think we can work towards increasing the number of MDIs in the United States, increasing the number of loans and the asset base that those banks have, as well as the CDFIs, and then seeing how their community performs in terms of the household wealth building. And we know that home ownership is one of the key elements there.
And sort of staying along that path, as you look at both the MDI and larger community bank ecosystem, what are the challenges that you're observing, and how can regulators help address them?
So there are a number of challenges along the way, and I have personally taken a look at a number of regulations that we have on the books. And the thing is that as a regulator, you're risk averse. So you're a little bit hesitant to kind of step out on a limb and try something new, or allow your financial institutions to do something new, because just about everything new introduces risk to the system. And if it's new, you don't know how to control it, how to regulate it, how to manage it. And it automatically is viewed, I would say, with suspicion. So what we're looking at is a number of initiatives on the regulatory front where our regulations can be updated to kind of follow technological and entrepreneurial innovation that we have seen in the financial services sector, and not necessarily only by banks. So part of that is looking for opportunities for banks to engage, including the MDIs, to engage with technology companies to be able to serve a broader base, to offer financing and origination platforms that a bank itself may not be able to develop because it's very expensive. And to frankly look at things that traditionally have not been approved by the regulators, such as the use of alternative data in underwriting models. We know that a large segment of the population does not have credit scores, and an even larger number does not have good credit scores, which would be 720 and above, which makes you highly bankable and gives you an opportunity to get a mortgage on favorable terms. And so looking at those things, then we started struggling with, well, how can we expand that financial inclusion? How can we make sure that more people can qualify for products that would bring them into the banking fold and actually make the system work for them? And so, most of the people, even poor people in America, have cell phones because that's the only way that they can communicate to the world. And they may not have a car, they may not have a job, but they will have probably a smartphone, maybe not the newest model, certainly not the newest model, but that's how they're using their financial services, and that's their kind of a window to the world. So looking at their use of different data points, paying their cell phone bills, etc., could be viable with a new technology, and this is what we call alternative data, could be a viable indicator of their willingness and ability to pay. And so we do have to expand the horizons as regulators, and this is frankly a completely apolitical issue. This is something that if we want a system that Americans feel, of Americans of all stripes and from all levels of the society, believe that they can belong, then we need to expand their participation in the system. And I use an example of when I first came to the United States with $500. I opened up a checking account the very next day. This was in July 30th of 1991. And then I realized that everybody in the United States is using a credit card. And so I wanted to have a credit card myself, and that credit card, was not available to me. I got denied because I had no income, no job, no assets, no credit score. And so I got denied, but I was offered an opportunity to send some money in and have a secured credit card, which I did, even though, it left me starving for most months. But I was building my credit. And then after I received an unsecured credit card, it helped me belong in the sense that I would swipe it in the grocery store, and no longer did I have to engage with a clerk and who may or may not have understood my accent, right? I actually belonged in a way that I didn't have to explain. And then that led to further financial products, including student loans and later a home loan and a car loan. And I had a good car that didn't break down all the time when I had to make it to work and go to college. So there's a benefit to bringing more people into the system because, frankly, over time, you want them to become shareholders in this system. You want them to become shareholders in the United States of America. And you will not do that if they're living on the fringes of the financial services system and on the fringes of the society, mistrustful of what the system has for them. And frankly, the system has a long path of proving value to people who have been disenfranchised.
Just staying with that for a second, last December, the FDIC joined with the Fed and CFPB, et cetera, about, in a joint statement on the use of underwriting for alternative data, as you've been talking about. And in your views, I mean, clearly you see what the benefits are with that, and you've experienced it, as you said. Do you find that there's more receptivity with the regulatory agencies, but most importantly with the banks, to use that alternative data in underwriting? And do you see that is something that will continue over the course of time? I
do. And actually, I'm very, very encouraged by the developments. And here's why. Banks, if they think that their regulator or regulators in general are going to frown upon something, they're not going to do it. There's no incentive to do it. Why? Because later on you will be, slapped with some kind of enforcement action, or you're going to be reprimanded through the confidential supervisory channels for doing something that wasn't, quote unquote, blessed by the regulators. So by issuing that guidance, we basically sent, it seems like a little thing and a little step, but we sent a green light to both banks and technology companies, and we said, go ahead and do it. Now, you have to be appropriately managing risks. You have to be appropriately managing your compliance with the requisite consumer protection laws and regulations. But go ahead, let's see what this new universe can do for people. And I think it can do a lot, which is why we have to be willing to take the risk of doing it. And I think we did that in December, and we're looking at alternative ways of kind of speeding up that process and allowing banks to engage with customers that they traditionally wouldn't.
Right. And, talking about modernizing things, right? The FDIC has undertaken a significant effort to modernize the Community Reinvestment Act, which obviously also addresses the needs for low and moderate income communities. The FDIC is one of the three agencies that is responsible for the CRA. Obviously, the OCC finalized a rule earlier this year. The Fed has announced a revamp of its side of the CRA for a 120-day comment period. How do you see these efforts in terms of modernizing the CRA progressing, and how do you expect financial institutions to move on with these efforts to do so?
Sure. And it's a great question, particularly because, you have three agencies that all kind of do the same thing, but have slightly different mandates. And so with respect to the Community Reinvestment Act, we worked for a couple of years on the revisions that eventually were finalized by the OCC in June of this year. We didn't finalize it together with the OCC at the time because our small banks were on the forefront of modifying loans and reaching to their communities, and frankly, originating PPP loans to make sure that the businesses in their communities can stay on top of the economic development and the business closures caused by the pandemic. And so we're looking now at the ANPR, Advanced Notice of Proposed Rulemaking, that the Federal Reserve put out there. And frankly, a lot of the questions that they're asking are the questions that we have asked ourselves in our proposal that we issued with the OCC. And a lot of the concepts that they're putting out there are concepts that resonate with what's in the OCC's final rule and the FDIC's proposal as well. So I'm hoping that there will be an opportunity to engage with the other agencies, both OCC and the Fed, to come up with a mutual solution. Because right now what we have the OCC final rule, which applies to national banks, and we have the old regime that frankly is in dire needs of updating for state banks that are regulated by the Fed and the FDIC. And so I'll tell you what I said yesterday. I'm on CRA issues, I don't have an agenda, and I'm willing to dance with whoever is willing to come to the dance floor. And optimally, I will have two dancing partners and one sheet of music. So we're hoping to get there.
There we go. You also before mentioned that regulators aren't apt to try new things, that they're scared to do so, or maybe reluctant to do so is probably a better way to put it. That's not the case with you, right? And last year you established an Office of Innovation, Fdic, at the FDIC. How are you leveraging that office to support financial inclusion?
Great question. And I'll tell you this, we are appointed to these offices for a 5-year term. And so if you're looking to make a consequential change in the regulatory framework and move the system forward, you can't accept the status quo. The status quo is absolutely unacceptable. So one of the reasons we created the Office of Innovation at the FDIC is to consider ways in which we can make our regulatory framework not just more technologically savvy, not just more forward-looking, but also more inclusive. And the opportunities there are frankly endless. You got to shake up some of the traditional systems that we have in place, and that requires regulators stepping out a little bit on a limb. And so through the Office of Innovation, we have engaged in two major initiatives so far. One has been to, we engage in this, we call it rapid prototyping with technology companies, and we just selected 14 companies to proceed to the semifinals on this. But the idea here is to basically eliminate the so-called call reports, quarterly banking data that we collect from banks. And an opportunity here is to see how is the system doing on a more timely basis, instead of waiting 4 months to get the data and analyze it from the banks, and to see how technology can be utilized there to frankly understand, is the system in risk? Is the system serving more people, less people? Where are the credit scores in the mortgage origination area, et cetera? And if we can get that information on a more timely basis, we will know how all segments of the society are being served by the financial institutions, banks predominantly, in addition to knowing how much risk there is in the system. So that kind of has a little bit of an esoteric connection to financial inclusion, but there is a component and nexus. The more direct, frankly, opportunity that we are engaging in through the Office of Innovation is we came up with the idea of a good housekeeping seal of approval. we like, at least I like acronyms at the FDIC. So we have this good housekeeping seal of approval process that would be a standard setting body and a public-private partnership that would allow fintech companies and third-party providers that want to team up with banks to get certified through this third-party entity. And the way that the certification process would work is that instead of a bank and the technology company that's looking to team up with a bank going through the first 50 items on the checklist, on due diligence checklist, when that company is getting to be onboarded with the bank, those 50 steps would be undertaken by this standard setting body. So when the fintech that uses alternative data to make loans, that this little community bank that may not have the resources technologically or in compliance department to proceed with this onboarding, they can take that certification and know that this company has been vetted and approved by the standard setting body, and then be able to onboard it more quickly so that they can start serving a broader segment of the population. So that's something that both of those initiatives are currently underway, and we're looking forward to seeing the impact and the effect of them when they're finalized.
That'll be fascinating to see how that unfolds, because you're also sending signals to the market as well,
yes.
Which is important. Just taking a little bit of a slight detour, but we'll make sure we stay on track with our issues here. But I believe in March of this year, Square became the first U.S. fintech company to receive a conditional approval of an industrial loan company ILC charter from the FDIC. Obviously, ILC charters allow non-bank owned companies to undertake certain deposit and lending services to customers without being subject to federal bank holding company regulations. Two questions here. The first one is, how do you view the process for and timing related to the approval of future ILC charters?
Great question, and now I feel like I'm in a congressional hearing getting questions. So here's the position I have taken on industrial loan corporations. It doesn't matter if you like them. It doesn't matter if you hate them. They are in the statutes and in the books. And when Congress gave us the authorization to approve certain applicants for deposit insurance, they basically gave us the same standards for banks and industrial loan corporations. So when we have an institution that's chartered as an ILC that comes to us for approval, if they're able to meet those statutory requirements, we have a duty to consider the application, and then our board votes on it. So I can't comment about any specific application. Certainly there was one that was, a couple of them that were approved after a long period of time. But I think we need to be cognizant of the fact, of two facts. One is that the regulatory agencies need to follow the rule of law and not set the rule of law. So and to be very blunt, if you don't like the ILCs, then that's something for Congress to consider. It's not for me to make my personal judgment as a regulator, because Congress told us that those are legitimate entities. So that's the position we have taken, and we have also engaged with the ILC applicants to make sure that they understand, because they don't have the Federal Reserve supervision at the holding company level, that it doesn't mean that the FDIC is just going to look only at the insured depository. So we enter in a couple of agreements, and one of them is the Capital and Liquidity Management Agreement that basically allows us to supervise the parent, and it puts the parent on the hook for funding the IDI, the insured depository, in this case the ILC, in case there are issues and it looks like the ILC would need to be resolved. So we are trying to ameliorate the absence of the Federal Reserve supervision on the holding company, but making sure that these entities do not represent additional risks to the system that have not been addressed either through an agreement or through our supervisory channels. So I would say, if you have applicants out there or people who are considering ILC as a viable entity, I would encourage you to engage with our staff. We have also changed the application process. So now there is the preliminary or confidential filing, where you come to us with your application and ask questions to understand what supervision by a federal banking regulatory agency looks like, and whether or not you can satisfy the requirements that Congress gave us to become approved for deposit insurance. And then once you go through that process, before you actually formally file, you would have the opportunity to withdraw the application if you don't want to proceed. Or if you decide to proceed, the application would be more complete on the day when it's filed. And then we as an agency have 120 days to either approve or deny the application. But we're no longer going to allow any entities to sit there in a limbo for an undisputed period of time.
Sure. Now, how do you also see the obligations of ILCs comporting with the requirements of the Community Reinvestment Act?
So we have imposed those requirements on the ILCs that we have, and frankly, some of them are struggling because most of them are concentrated in a couple of states, and so the CRA opportunities in the areas where they're headquartered become exhausted, believe it or not, become exhausted. So part of the reform of the CRA that we have looked at with the OCC and the Fed is how to expand the footprint of where they could invest in low and moderate income communities that is not necessarily tied to the headquarters of where the institution is. And this would look at literally the areas where they bank and offer services, even if they don't have branches there. So I think that has been a huge advantage of the OCC final rule that, frankly, is something that we and the Fed should adopt because it allows us more flexibility in making sure that the greater geographic area is served by the CRA and by these institutions, but also it allows these corporations an opportunity to basically go in and serve the needs of a broader range of constituents that they have, even if they're not located in their immediate geographic area, as is required under the current rules.
So, clearly the FDIC has taken a leadership role with minority access to capital, with minority financing, as we've been talking about. As we also talked about, you are bullish on the American system and the ability.
I'm sorry, let me just fix this real quick.
Oh, no problem.
All right, go ahead.
No problem at all. At least this wasn't yesterday. I was doing an interview like this yesterday with somebody from the New York Fed, and my system crashed. So
don't worry, I'm just waiting for one of my two mascots to jump in my lap, so we're good.
But as I was saying, the FDIC has taken a leadership role here with the minority access and minority financing issues, and you've been very bullish on the American system and democracy. What's given you hope, and how are you viewing the ability of our country to make progress on these issues that have been with us in some cases for hundreds of years?
So I'll tell you this: I think it helps that I have a perspective of somebody who was born elsewhere, and I also have a perspective of somebody who has extensively traveled throughout the world and has the intellectual curiosity in all those places to kind of absorb what's going on, to ask questions. And I will tell you this, the reason that I believe in the United States of America is because there's no other system in the world that would allow somebody like me who came here with nothing, with no parents, no connections, no money, and frankly, limited knowledge of English language back in 1991 to transcend not just my place in the society, but transcend the obstacles that were along the way and to rise to the levels that I have risen to. And it is my duty now to speak for the system that, frankly, hasn't been easy to come to the place where I'm at. But I also know that this system, we shouldn't just tear down the system. We should make the quirks and improvements to the system because there's no better system out there. I have not found it, and I've lived elsewhere. I've traveled, and I've studied different systems. I have friends who emigrated at the same time when I did. They went to Germany, they went to Canada, they went to Australia, they went to Britain, France, Austria, a lot of the truly developed countries. And I will tell you that they have encountered obstacles along the way that have been similar to my obstacles, and they have not been able to overcome them because the system was just not built for the level of entrepreneurship and I would say hustle that, in America, if you do that, you can succeed. And so I wouldn't throw, as they say, the baby with the bathwater. I would work on improving the system, and I am frankly indebted to the United States for the opportunity to succeed. And not to say that it was easy. There were certainly months where I was hungry, and at some point I got to write a book about my life because I had to drive 80 miles each way to go to college because I couldn't afford to live in the vicinity of the college. And after working 3 minimum wage jobs, I would be left every month in the early 90s with $20, $25 for food. And so it hasn't been easy. I don't want people to think that it has been easy, But I do believe that if we can remove the barriers in the system that frankly are kind of a multi-pronged, and it goes with the educational system, with the community you're in, with the quality of the community you're living in, the infrastructures in the community. I can't fix all of that, but if I can fix the financial opportunities and remove the barriers in the financial system, I would say, job well done. Let's move on to the next way of improving the system as it is.
Yeah, and I mean that's the concept, right? Of if you can improve your little corner of the world, you know what? If everybody's doing that collectively, it's going to be a much better place, right? And with that, what has been interesting about this stream of work that we've been involved in, and the conversations we've been having, is that there are a lot of these conversations happening around the country, right? Within the private sector, within the public sector. One of the reasons why we thought it was very important to have you with us today was you've taken such a leadership position on this early on, before others were looking at this, that you have really been using your position to help push this forward. And as I was saying, one of the interesting things is that if we're going to help resolve these issues, entrepreneurship has to be a part of it, right? And part of the issue has been historically that Black Americans do not have the same access to financing as others. As a result, they are starting businesses that have a higher likelihood not to succeed or to grow, which leads to bigger business failures. And what is interesting now is we're actually seeing some businesses start to do some innovative things where they're recognizing those problems. And then what they're starting to do is also to access Black firms in ways that they hadn't before, right? So as I said, Allstate is working with some Black firms to help them with some bond issuances, or Square made sure to put a certain amount of its cash in CDFIs. And those have important knock-on effects, right? Because if we can build up those institutions, then they can help provide more high-quality funding for entrepreneurs who can start those businesses that have a greater chance of success. From your vantage point, because you sit, on a higher perch overlooking this system of ours that is an important part of the solution. How do you see that we can bring the private sector and the public sector together to start to marry up some of these solutions and to help push them forward for a lasting impact?
And I'll say that we don't have a choice but to bring the private and the public partnership and the sectors together here, because it's government alone is not going to solve this, right? If government alone had been able to solve this, we wouldn't be here where we are. So it's going to be a part of the larger ecosystem to be invested in the success of everybody in the United States of America, and particularly African American community and people of color in general, because we want the system to work for everybody, and we want opportunities for everybody. I want to see, little Jelena in the African American community be able to rise in 20 years and become the FDIC chairman, and in the Hispanic community, et cetera, and so forth. And the truth of the matter is that I think that early education and how the infrastructure is set up in these communities is something that there hasn't been enough emphasis, or if there has been enough emphasis, not enough effect has come out. So the part of the reasoning behind this MDI fund that we came up with was exactly that, to create a public-private partnerships. The FDIC stands behind this fund, not in terms of guaranteeing the fund, but in terms of I would say the monitoring of the fund, making sure that it's doing what it's supposed to do. It will have its separate board, et cetera, et cetera. But we put our weight, the gravity of the FDIC office behind it, so that entities that are looking to invest know that this is not going to be just one and done, and we write a check and it's done. We are invested in the success of this fund, and so we're hoping that more private entities will look at this as an opportunity to give us an opportunity to work as a bridge between the MDIs and the communities that they serve, and private corporations on the other hand, and so that the ecosystem itself is able to better prosper. And you know what? People need to understand that there are benefits to having an entire class of people lifted and put at a level where they become better consumers. They become better educated consumers. They become more able to consume and more able to be engaged in the system, better educated, etc. And so giving along the way these opportunities is not just something that you look at educational system to do, or you look at somebody in that community to do. It has to be one of those things where we hold hands and say, hey, listen, if I have the technological expertise and you don't, let me share some of that technological expertise. Again, I use the analogy of your neighbor's yard, and if it doesn't look good, automatically the value of your house is not as strong as it might have been otherwise. So sooner we recognize that we're kind of involved in this very connected, symbiotic ecosystem, more likely are people going to understand that government alone is not a solution. Private investment alone is not a solution. So having some kind of a confluence of events by removing regulatory structures that have not been serving communities well over the decades, and then having the capital infusion and the interest and the willingness of the private sector to engage and to do more, that we'll get to the outcome that we need.
Well, Chairman McWilliams, thank you very much. We'll leave it at that high note. Thank you for joining us today. Thank you for your leadership on this and many other issues. We look forward to working with you on these issues. And I'd also like to thank Julie Stitzel, Rick Wade, and Tom Sullivan for their leadership with the Chamber on minority access to capital issues. And finally, I'd like to thank Ashley Eisner and our great audiovisual team for putting today's event together. Thank you all for joining us today.
Thank you as well, Tom, and your staff on this wonderful presentation. Thank you.
Thank you.